And on today's show, how end-of-the-year charitable giving strategies can benefit taxpayers and charities. Part one of this week's series on end-of-the-year charitable giving strategies for 2014 with top producers Mike Kilbourn, CLU, CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Rob, Michael. Thanks. Again, boy, a couple weeks back to back. I love it. We're talking about your favorite subject. Now, last week we talked about a lot of end-of-the-year tax planning strategies. Now we're talking about we're going to blow up, one of our episodes was just on charities, and I don't know too many people that are into it. You guys are deep and into the weeds on charitable giving, and how strategic is it in your practice, Mike?
Well, it is strategic because, again, my clients are typically older, and they are looking at this, they're at the end of their life where they can actually, in the pyramid of priorities, they can add charity pretty heavily. And they want to. And we can show them ways that they can benefit not only the charity, but themselves and their family.
I think there's a misconception, though. Isn't it true, Mike, that most people say one of the reasons why they may hesitate on giving is because they say, well, I'm giving up an asset, and I'm really not going to get anything in return, and I'm still not sure about giving up control or income.
That's exactly right. And we can show them how they don't give up control, and they won't give up the income.
That's huge.
Yeah, my clients are younger, and the nice thing about charitable planning with them, for those who are charitable, is that it gives them immediate gratification and tax savings. So we help them integrate their charitable giving, their financial planning, tax planning, and estate planning.
Now, would you say you more represent Gen X versus millennial?
My clients are baby boomers, which is in between the mature generation and the Gen Xers. But I do have Gen X clients as well.
Well, that's Mike and I. We're the boomers. So when you see them, you're at the end of the year, and you've already talked to them about end of the year planning as regards to charity as one idea.
Well, boomers are great. Why? Because you guys grew up in an area where affluence was emerging in the United States. So you're idealistic, you're optimistic, you're forever young. I mean, death is optional for you guys.
Thank you.
And so charitable planning plays right into that.
Well, why don't you walk us through some of your things on your mind map, your patented mind map, I must say. And I want to just say for our viewers, if you missed last week's show, we use the mind map quite often, and it's really great because it's not on this analog timeline that you see all the time, this linear graph. This is really something I find to be not only the dimension, it makes me look at everything in a bigger picture. And I think I get a holistic view. That's the bigger issue.
Exactly. You get to see everything.
Well, walk us through the first one. What do we want to talk about? Outright gifts. I mean, I kind of get that, but let's make sure we cover it because we want to touch base on everything you can do. This could be a little end of the year planning, but now we're doing it for complete benevolence.
Correct.
Let's just see what we want to do here.
You give it away, it's gone.
Right.
And you receive a tax benefit. The two types of assets that most people contribute is cash, called checkbook giving. And for that, when they give a dollar to charity, they can deduct up to 50% of their adjusted gross income. Now, if they're giving to a private family foundation, they can deduct up to 30% of their adjusted gross income.
In any 1 year. So and they can have 5 additional years to carry it forward. So that's a total of 6 years if they can't use it all this year.
So there's a cap. Well, these are your two caps. If I can't use it all, I can forward it. And do I have to amortize it for the 5, or can I just use it as I need it?
You use it. Yeah, you have to use it. No, you use it in terms of you use it next year 50%. And there's any excess of that, up to 50% in there.
So you might be able to do some of that, but maybe the second year done.
Right.
Okay, but you have up to 5 or 6 years.
Correct.
To get this done. And this is on cash.
Cash only. Now, the better asset to give if you have an appreciated stock or cash is always depreciated stock. And so the rules are slightly different as it relates to appreciated assets. Here, if you own a stock or mutual fund that's long term, 12 months and 1 day, you can deduct up to 30% if it goes to a public charity. That's at the fair market value of that security and the date that it was given. You also avoid capital gains tax, and that is very big. Now, if it's a short-term gain, sometimes you won't give that, but let's say you bought a stock in January or sitting here in December and it's gone off the charts in 2014, you can still gift that, but your basis in that security becomes what you deduct, and you can deduct up to 50% of adjusted gross income.
Because it's like cash in a sense.
It's like cash, but you avoid the short-term capital gain, which is effectively ordinary income.
Now, of course, we're just giving this, whether it's cash or appreciated assets, we're just giving it to the charity, getting whatever the deduction under these terms and under the cap. So I've done that. That's all I'm getting, though, is it's just I'm being benevolent.
Correct. And
now, so if you give an appreciated asset, you're getting the deduction for the full value of it, not if you sold it and paid tax and you had the cash, you gave the cash. Well, that wouldn't be nearly as good as giving the asset, because now you can you say, well, I've got the cash that I didn't donate. I can go buy the stock, and my basis is all the way back up to the higher amount rather than what.
Now, Mike, how many times do you see this is a major mistake? Right? People
without a
they
doubt.
sell it off, pay their tax, then they said, "Oh, I wanted to give this all along."
Big mistake.
Right.
Because a charity can sell it, and they don't have any tax to pay, so they can sell it and get the full value.
So you're getting the full value of the deduction by giving to them, and they use it. You're not paying any tax on
the
this.
capital gain.
Yeah.
And the thing is, no advisors are not bringing these ideas to their clients. Just not happening. The CPA is not going to tell them, and the investment advisor is just off their radar screen. And
I
so
would
it's
have
an
thought
opportunity.
that most advisors who like to harvest gains and losses at the end of the year would look to this as another tactical play. But you're saying hardly any advisors pick
It's
up on
because
this.
often the tax and the financial investment people are not communicating, and just on the client's best behalf.
Well, when I'm looking at this, I'm looking at your basic play here, and I love the way you've mapped this out. So I'm going to look at my cash positions, I'm going to look at my appreciated assets, and I'm going to start making decisions, and I have up to 6 years to play if I need it.
Yes, this year plus 5 more.
Well, I love
Many
that.
of my clients, we look at years of spiked income, and we'll prepay their charitable gifts in something called a donor advised fund. There'll be a future show on that topic.
We come back from the break, I'm going to ask you exactly about, what did you say? Prepaid?
Charitable gifts.
Wow. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with Rob O'Dell and Mike Kilbourn. We're talking about end of the year charitable giving tactics. You kind of caught me off guard there. Prepaid. It sounds like, am I doing this in advance now? Talk to me about that.
Well, we have clients who maybe are just entering retirement. Maybe 2014 is their last year of employment income, so they might be in a higher tax bracket. And we're looking as they get into retirement in their late 60s, they still want to give to charity, but the benefit of that charitable tax deduction is not as great in retirement years when their brackets are in lower brackets, their income is down, versus high income. And so what we might do is go in, and maybe they work for one company and they have a bunch of stock in this company. We might pay 5-10 years in advance of, meaning make them gift now, into a donor advised fund, and then have them from their donor advised fund give the charity over the next 10 years.
Okay, so when I'm thinking about that from a strictly this year, I can do that still
do it right
this
now.
year.
Right, and you get the full deduction, and then you don't. Maybe you could even skip a year if you don't want to make a donation next year with a donor advised fund that we'll be talking about. So
Now, what about below the line deduction?
Yeah, this is when people make charitable gifts, it's called below the line, meaning that you have adjusted gross income is on the front page, but this comes off Schedule A itemized deductions. And so this will not reduce their adjusted gross income, which is a threshold for a lot of these different tests of various stealth taxes that are out there. It will not affect their 3.8 Medicare surtax, but it will reduce taxable income. And so you just need to be aware of that. Let me give a couple examples here. And I did one right here. Here we have someone in their mid-50s. They make $400,000 of adjusted gross income, of which $250,000 is earned income, $100,000 qualified dividends, $50,000 interest. If they do nothing, they just take the standard deduction, their tax liability would be $95,000. Now, let's say this is their last year of income and we want to accelerate or prepay their charitable gifts. I'm going to give an example here. Let's say they go ahead and they set up a private family foundation. Now, if you remember from the previous show, private family foundations do not get the same tax benefit that a public charity does. So here, if they were to give cash, the maximum deduction they could take is $40,000, and that would save them $40,000 of income taxes. That's cash in the pocket, that $40,925. So if they give $120,000, $40,000 comes back from the government.
Now, and this is in a private family foundation.
Now, if they're going to give a low basis stock, the maximum charitable deduction they can take is $80,000 or 20% of adjusted gross income, and that would result in a tax saving of $27,000.
Now, do you see this tactic used by people, families of wealth, who have a private foundation, maybe because they have specific things that they want to create in their charity, as well as they may want to employ some family members?
Correct.
yes,
This is a huge issue for them.
Right. And typically, if someone's going to do a private family foundation, they have a little more means. What we see most of the time, Mike and I do, is a donor advised fund, which qualifies as a public foundation.
and so donor advised funds are kind of the poor man's private foundation.
But Mike, I've heard you speak on this before, and it doesn't sound like it is a pretty big deal for the middle class. Even people with big hearts but small wallets, that is a play.
Oh my God, it's such a simple way to give, and you can do, again, you can fuel this plan with dollars that don't have to be given away immediately. They can be given away over time by yourself, your family members, maybe when you're gone, your children and grandchildren, helping keep your name alive with your charitable intent alive through this donor-advised fund.
So the maximum, if they were to give cash to a donor-advised fund or for any public charitable organization, the maximum deduction they could take in the current year is $200,000, which is 50% of their adjusted gross income. If they were to give the maximum gift, their tax savings would be $61,000. So all of a sudden now, instead of paying a tax liability of $95,000, they're paying somewhere in the neighborhood of $34,000 of taxes. We would recommend, if you have appreciated stock, give the appreciated stock away. They could deduct up to $120,000 and save $40,000 of taxes.
No, I'm sorry, but just my first glance at this, I'm comparing a private fund deduction versus a gift to public charity, and I think I've heard you speak about this, Rob, about there's a lot of public domain information out here on your so-called private foundation.
There's nothing private about it.
Nothing private about it. But this seems to be a bigger play. I mean, my deductions are bigger. Why would people more gravitate to this? You know, public charity using donor advised funds versus foundation.
Well, foundation, they're going to have, that might be something that where we're talking much larger dollars involved and something they want to have carry on for many generations. Now, quite frankly, you can have that work with a donor-advised fund, but there's a control element. So with a private foundation, the family controls where the gifts are made.
And they're not mutually exclusive, meaning that most of my clients who have private family foundations also have a donor-advised fund right with it. And the reason why is, one, they can layer those tax deductions, and two, if they want to do anonymous giving, they can do it through their donor-advised fund.
Okay, so I see some, not only America's benevolent heart here, and the tax code's actually playing with it, but I also see these choices. Now I hear that you're telling me, if I understood you correctly, that you can do this in tandem.
Right.
Right. In fact, a private family foundation, they could take their required 5%, and couldn't they pay it to a donor?
It needs to go to, yeah, it could go to, that's a good point. They could take the minimum distribution of 5%, right, that they're demanding, and they could go to a donor-advised fund, which is a public charity.
Now, so they're required to give 5% a year away from the private family foundation, but now that it's in a donor-advised fund, now they can slow down that required 5%, and they can spread it out over a number of years if they want.
So there's a lot of flexibility, especially if you have the wherewithal and the heart to do this, to using both.
The public isn't aware so much of this donor-advised fund business, and they all say, well, I don't make enough, I don't have enough assets to do a private family foundation. Many say that. And so they need to be made aware of this, and I think it would be advisable for the advisors to tell them about it.
In fact, the last show in our series this week will be on the differences between private family foundations and donor-advised funds.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant, and we'll see you tomorrow.